Have you ever looked at, say, a company's financial reports, maybe a local shop or, some huge corporation you're interested in, and wonder why they can look so different? How do these businesses actually tell their financial story? What rules are they even playing by? Because understanding the financial health of any business, it's pretty crucial, isn't it? Whether you're thinking of investing or maybe you work there or you're just curious about the world. So today, we're doing a deep dive into this, well, sometimes complex, but always fascinating world of financial reporting frameworks, specifically in the UK and Ireland. And our guide for this is a really key document. It's the overview of the financial reporting framework, and it was published by the Financial Reporting Council, the FRC, just back in March 2025. So it's current, and it really lays out the ground rules for how companies present their numbers.
Exactly. And our mission today, for you listening, is really to unpack these different ways companies over here report their financial performance. We want to help you understand not just what the choices are, but I think more importantly, why those choices matter. What do they mean for the information you actually get? It's about demystifying something that can seem pretty dense.
Okay, so given the FRC wrote our source document, let's start right there. Who exactly is the FRC? What do they actually do in setting these standards? Are they like the referee, or are they writing the rule book too?
That's a good way to put it. The Financial Reporting Council, or FRC, yeah, they're definitely both. Their main purpose, their core mission, is to serve the public interest and support UK economic growth. And they do that by upholding really high standards across corporate governance, corporate reporting itself, audit, and even actuarial work.
Okay, so pretty broad remit then.
Very broad. Think of them as the main guardian of financial integrity in these areas. They actually set the UK Corporate Governance Code, the Stewardship Code. They establish the UK accounting standards we're talking about today, and actuarial standards too. Plus, they monitor how good company reporting actually is, and they have independent enforcement powers.
Right.
And crucially, maybe the biggest piece, they're the competent authority for audit in the UK. That means they set the auditing and ethical standards for auditors, and they monitor and enforce the quality of audits.
So they write the rules, check they're being followed, and step in if they're not.
Precisely. Rule writers and the referee. Yeah.
Okay, so with the FRC setting these big standards, how does that translate down? What are the actual sort of structures or frameworks companies use day to day for their financial reporting in the UK and Ireland?
Well, basically, UK and Irish company law recognizes two main financial reporting frameworks. Big picture frameworks. First, there's something called adopted IFRS. That stands for International Financial Reporting Standards. These are used, well, internationally.
Okay, the global ones.
Exactly. And then the second main one is UK and Ireland GAAP. GAAP stands for Generally Accepted Accounting Practice. And this framework is specifically based on UK and Irish company law requirements and, importantly, on the accounting standards set by the FRC themselves.
Right. So you've got the global option, IFRS, and then a more local one, UK and Ireland GAAP.
That's the essence of it, yeah.
So sounds like there might be choices involved, but is it always a choice? Are certain companies forced down one path, and why would that be?
That's a really critical point. While lots of companies do get a choice, it's definitely not universal. Take publicly listed companies, for example, the ones whose shares you can buy on the stock exchange. They must apply adopted IFRS when they prepare their consolidated group accounts, their main big group account.
Why is that? Comparability.
Mostly, yes. Comparability is key for investors looking at listed companies across different countries. Since IFRS is used globally by many listed firms, it makes sense. However, for their own individual parent company accounts, just the parent company itself, they actually do have a choice. They can use adopted IFRS or UK and Ireland GAAP for those.
Interesting nuance there.
It is. And for most other entities, non-listed companies, smaller businesses, the choice between those two big frameworks, IFRS or UK GAAP, is generally available to them. And just to mention, there's a specific standard, FRS 100, application of financial reporting requirements, which sort of sets out the overall structure for that UK and Ireland GAAP side of things.
Okay, so we've got these two big umbrellas, IFRS and UK GAAP.
Yeah.
But you mentioned FRS 100. Does that mean within UK GAAP itself, there's like even more detail, more options?
You're absolutely right. Yeah, that's where it gets really interesting and tailored. Within that UK and Ireland GAAP framework, our source document flags up 5 distinct regimes. You can almost think of them as rungs on a ladder.
A ladder of complexity, maybe?
Exactly that. A ladder of complexity, giving companies options based on their size and needs. So you've got FRS 105, that's for microentities. then Section 1A of FRS 102 for small entities, then the main General FRS 102, then FRS 101, which is called the Reduced Disclosure Framework, and finally, there are specific reduced disclosures for subsidiaries and ultimate parents within FRS 102.
Wow. Okay. 5 options under just one umbrella.
Yes. And the document actually has a diagram 2, that shows this idea of increasing complexity. It's quite helpful visually. What's really fascinating is the further up this ladder you go, starting from FRS 105 at the bottom, up towards the full FRS 102 or even adopted IFRS, the more comprehensive and, frankly, the more demanding the reporting requirements become.
Makes sense. Bigger companies, more complex rules.
Exactly. The complexity directly correlates with the increasing size and, the intricate nature of the businesses using them. But here's a really key point. An entity can always choose to opt out. They can choose a more complex, comprehensive regime, even if they technically qualify for a simpler one lower down the ladder.
That is interesting. Why would they do that? Just eligibility doesn't seem to be the only factor then. What else are companies thinking about when they choose their rung on this ladder? Is it purely size or other things too?
It's definitely more than just ticking the size boxes. First, yes, you have to meet the clear eligibility criteria. Things like, are you preparing individual or group accounts? What are your turnover and balance sheet figures? What type of legal entity are you?
Right, the basics.
The basics. But beyond just qualifying, companies must think about what's appropriate for them. And that appropriateness factor is crucial. It means looking at, say, the characteristics or maybe restrictions of a particular regime. Do they have the resources, the time, the expertise, the money to comply with more complex rules? Because more complex means more cost.
Sure.
And critically, what information do the users of their accounts actually need? Think shareholders, lenders, maybe even key customers or suppliers.
So if you want to attract serious investment, maybe you opt up for more credibility, even if you're technically small.
Precisely. A more comprehensive set of accounts under, say, full FRS 102 might be seen as more robust and transparent, even if you could have gotten away with the simpler Section 1A rules. It sends a signal.
Okay, let's zoom in then.
Yeah.
You mentioned FRS 105 for microentities right at the bottom rung. Tell us about that. Who qualifies and what makes it so simple?
Right. FRS 105, the microentities regime, these are the absolute smallest subset of small entities. FRS 105 is essentially a massively simplified version of FRS 102. Eligibility in the UK? Well, for financial years starting on or after April 6, 2025, an entity is micro if it generally doesn't exceed 2 out of 3 thresholds. Turnover of £1 million, a balance sheet total of £500,000, and an average of 10 employees.
Tiny.
It's very small. Eligible entities are typically companies, LLPs, and qualifying partnerships. But certain types are ineligible, like financial institutions, charities, parent companies preparing group accounts, or companies whose accounts are already included in group accounts.
And Ireland, similar idea.
Similar idea, slightly different thresholds and dates. For financial years starting on or after January 1st, 2024, though they could optionally use it from 2023, an entity is micro if it doesn't exceed 2 of. Turnover 900,000, balance sheet total 450,000, or 10 employees on average.
Okay.
Again, eligible entities include companies, qualifying partnerships, charities in this case. But ineligible ones include investment undertakings, financial holding companies, parent companies doing group accounts, subsidiaries included in group accounts, entities listed on regulated markets, credit or insurance institutions, and public interest entities. Generally, the more complex or public-facing entities are excluded.
Right. So what are the key features? What makes FRS 105 so different?
Okay, here's probably the most surprising feature for many. Accounts that comply with just the legal minimums under FRS 105 are presumed in law to give a true and fair view.
Presumed. So the directors don't have to worry beyond ticking the boxes.
Essentially, yes. The directors are not required by the standard to consider if any additional information is needed to achieve that true and fair view. The law presumes it's met if the minimums are hit.
Wow. That's minimal.
It really is. Statement-wise, you only need a balance sheet and a profit and loss account. That's it. No cash flow statement, no statement of comprehensive income, no statement of changes in equity. And the formats are heavily condensed. Like, the balance sheet might just show fixed assets as one line, not broken down.
Okay. And accounting treatments.
Big simplifications there, too. No fair value accounting or revaluations allowed. Assets can only be measured at cost. If a company previously revalued assets, they actually have to remove those gains when they transition to FRS 105.
Right. Cost only.
There you go.
Very basic.
Very basic. Disclosures are also extremely limited, just a few legally required notes about things like off-balance sheet arrangements, employee numbers, director loans, and major financial commitments. Companies can disclose more voluntarily, but they don't have to. And other simplifications include no deferred tax, no complex accounting for things like equity-settled share-based payments. Most accounting policy choices are removed, which often leads to recognizing income and expenses earlier than under other standards.
And no group accounts possible under this regime.
Correct. No consolidated financial statements can be prepared under FRS 105. It's purely for individual microentities.
Okay, FRS 105 is truly bare bones then. But as you said, most businesses will outgrow that fairly quickly. What's the next step up? That small entities regime using Section 1A of FRS 102. How different is that?
Right. Section 1A, small entities of FRS 102. This was developed specifically for those slightly larger but still legally defined as small entities. It builds directly on the main FRS 102 standard, so it's considerably more comprehensive than FRS 105.
And the eligibility. What makes companies small for this purpose?
Okay, in the UK, again for financial years, starting on or after April 6, 2025, an entity is generally small if it doesn't exceed 2 out of 3 criteria. Turnover of £15 million.
Big jump from micro.
Huge jump, yes. 15 million turnover, 7.5 million pound balance sheet total, or an average of 50 employees. So a much wider range of businesses fall into this category.
Who can use it?
Eligible entities include companies, LLPs, and basically any other type of entity that would meet the small companies regime criteria if it were a company. But again, some are ineligible public companies, and financial institutions like insurance or banking firms generally can't use it. Regardless of size, public interest is higher there.
And Ireland again. Similar criteria.
Very similar thresholds, just in euros and with slightly different dates. For years starting on or after January 1st, 2024, or optionally 2023, it's 2 out of $15 million turnover, 7.5 million balance sheet total,
Right.
or 50 employees on average. And similarly, credit institutions, insurance undertakings, and public interest entities are generally ineligible in Ireland, too.
Right. Now, you mentioned that huge difference with FRS 105 about the true and fair view. How does that work for small entities under Section 1A?
This is a critical distinction. Unlike microentities where it's presumed, directors of small entities using Section 1A are legally obligated to prepare accounts that give a true and fair view.
So the buck stops with them. They have to use their judgment.
Absolutely. This requires the directors to actively consider whether the minimum disclosures specified in Section 1A are actually enough. They might need to provide additional disclosures beyond the minimums to ensure the overall picture is true and fair.
Okay, so more responsibility there. What about the actual statements required? Still just a balance sheet and P&L.
Those are the minimum, yes. But because of that true and fair obligation, directors may find they need to prepare other statements too. Perhaps a statement of comprehensive income or a statement of changes in equity, or maybe an income and retained earnings statement, if that's necessary to give that true picture.
And the accounting itself.
Yeah.
Measurement recognition. Is it still cost only like micro?
No, this is another big difference. Section 1A generally follows the more comprehensive measurement and recognition requirements of the full FRS 102 standard. This means things like fair value accounting and revaluation accounting are permitted, so companies can choose to value certain assets at their current market value if they wish, which isn't allowed under FRS 105.
Right, more flexibility.
Definitely. And another significant change coming in, significant operating leases will need to be recognized on the balance sheet starting from January 1st, 2026 under these rules.
The lease accounting changes finally hitting smaller companies too.
Yes. So instead of just treating lease payments as an expense, companies will show the right-of-use asset they're leasing and the corresponding lease liability on their balance sheet. It gives a much fuller picture of their commitments.
Okay, what else is different from micros?
Well, things like derivatives, deferred tax, that future tax liability or asset and equity-settled share-based payments, like employee stock options, are recognized under Section 1A. These complex items were ignored under FRS 105. Plus, FRS 102, and therefore Section 1A, includes accounting policy choices. For example, deciding whether to capitalize development costs or borrowing costs, add them to an asset, or just expense them immediately. Small entities have to make these choices, whereas microentities didn't have them.
More judgment calls for the directors again.
Exactly. Though simpler accounting for loans to directors is permitted under Section 1A, which can be helpful for smaller owner-managed businesses. And just briefly, the main FRS 102 standard itself, which Section 1A is based on. that was first issued way back in March 2013. It's designed for general purpose financial statements aimed at a wide range of users, shareholders, lenders, employees, etc., who need more detail than micro or even Section 1A provides. It's sort of based on the global standard for SMEs, IFRS for SMEs, but adapted for the UK and Ireland.
Okay, that distinction between presumed true and fair for micro
Yeah.
and an active obligation for small entities under Section 1A, that's a really crucial takeaway. Our source document also mentions a decision tree, diagram 3, that sort of visually lays out these paths. How does that actually help a company navigate this?
Yeah, it's basically like a flow chart. It guides a company through the logic. It starts by asking simple questions like, are you a company? If yes, then it points you to check if you meet the micro entity criteria, those very low thresholds we talked about. If you do qualify as micro, you have the option, apply FRS 105. Or, remember, you can always choose to opt up to a higher regime like Section 1A or even full FRS 102 if that suits your needs better. Maybe you plan to grow fast or seek external funding.
Right, and if you don't qualify as micro,
Then the tree asks, okay, do you meet the criteria for the small entities regime, those higher thresholds, 15 million turnover, etc.? If you do qualify as small, you can apply Section 1A of FRS 102, or, again, you still have the choice to opt up further to full FRS 102 or even adopted IFRS.
and if you're not micro or small, too big for both.
Then generally, you're looking at applying the full FRS 102 standard as your minimum under UK GAAP. Or you could choose to apply adopted IFRS instead. It's a pretty logical pathway, trying to match the reporting requirements to the scale and complexity of the business.
That makes a lot of sense. Okay, we've covered individual companies pretty well, but what happens if you're, say, a subsidiary, part of a bigger corporate family? Are there special rules or maybe simplifications for those entities?
Yes, absolutely. The framework recognizes that scenario. For qualifying entities that are part of a larger group, there are actually 2 additional optional reporting regimes they can choose from. Both of these are specifically designed to make group reporting more efficient and, frankly, more cost-effective.
And how to do that?
By allowing the subsidiary to use accounting policies that are consistent with their parent company, but, and this is the key benefit, with significantly reduced disclosure requirements in their own statutory accounts. It can save a lot of administrative hassle.
Okay, what are these 2 options?
The first one sits within the FRS 102 world. It's called Reduced Disclosures for Subsidiaries and Ultimate Parents under FRS 102. So it uses the main accounting principles of FRS 102. To be eligible, the entity needs to be a member of a group where the parent company prepares publicly available consolidated accounts that give a true and fair view, and the subsidiary itself has to be included in that consolidation.
Any size limits on this one?
No, the document doesn't mention specific size thresholds or ineligible entities for this particular FRS 102 option. It's more about being part of that consolidating group structure.
Right, and the second option?
The second option is based on the other main framework, adopted IFRS. This one is called the Reduced Disclosure Framework, or RDF, and it's set out in FRS 101.
So IFRS principles, but fewer notes.
Exactly. The eligibility is very similar to the FRS 102 version. You need to be a member of a group where the parent prepares publicly available consolidated accounts under IFRS that give a true and fair view, and you need to be included in that consolidation.
Again, no size limits.
Again, no specific size thresholds mentioned. However, there are some ineligible entities flagged for FRS 101. Charities generally can't use it, and certain entities applying the big insurance standard, IFRS 17 from January 1st, 2023, are also excluded.
Okay, so to recap that bit, if you're a subsidiary included in publicly available group accounts, either UK GAAP or IFRS-based, you might be able to use the same underlying accounting rules as your parent, but skip a whole load of the detailed disclosure notes in your own accounts.
That's pretty much it, yes. You apply the recognition and measurement rules of either FRS 102 or adopted IFRS, depending on which reduced disclosure regime you qualify for and choose, but you get significant exemptions from the disclosure requirements of those standards.
Sounds like a really smart way to balance things for group companies. Get consistency without quite so much reporting burden at the subsidiary level.
It is, and it really underscores the core insight here, I think. The whole UK and Ireland financial reporting framework with all these layers and options. It's been meticulously designed, really. It aims to provide appropriate levels of detail and complexity based on who the company is, its size, its nature, whether it's part of a group. It's constantly trying to strike that balance, that crucial balance, between giving enough transparency for people using the accounts and managing the actual reporting burden, the cost and effort for the businesses themselves.
And for you, the listener, hopefully getting your head around these frameworks equips you with, well, just fundamental knowledge, really. To better interpret the financial statements you come across, you can now recognize the level of detail you can reasonably expect from different types of businesses based on which regime they might be using. And you can appreciate the sometimes complex regulatory world these businesses have to operate within. Which leaves us with maybe a final thought to ponder. We heard that for microentities using FRS 105, their accounts are actually presumed by law to be true and fair just by meeting the minimum requirements. So if that's the case, what does that really imply about the nature of truth and fairness in financial reporting itself? And maybe how much responsibility should ultimately rest with the directors versus the standard setters who create these frameworks with built-in presumptions? Something to think about next time you look at a set of company accounts.